So we are live now.
I will go on mute. Stephen, I can't see your video.
No, I've got it turned off for the moment.
Okay.
Hello and welcome to our webinar on the FCA Impact on Insurance Pricing. So it's obviously a big topic in the industry at the moment, and I would like to share some ideas about how it may impact, what insurers can do to prepare for it, and how customer behavior may change as an impact of the changes. First, a bit of a background. So at Pearson, we help our insurance clients improve performance in several key areas, from pricing strategy and planning to improving pricing effectiveness through governance, processes, and systems. And we can take this through to implementation, so doing predictive modeling and price optimization as well. We also offer external looking propositions, including daily market price tracking for home insurance and for motor insurance to give a real good view on what's happening in the market and how the competition is moving. If you'd like to know a little bit more about us, then you can select the links in the chat. And we have an insurance pricing brochure, which is generic. And we've got one which is more specific to our market price tracking products, so home insurance and motor insurance. So please feel free to click on the links in the chat and download those PDF brochures. Okay, so today we're going to be looking at the FCA and the announcement that was made in September concerning their impact with the proposals following its investigation into general insurance pricing. So here is what they've said. The home and motor insurance markets are not working well for all consumers, especially those who remain loyal over a number of years. Specifically, it is the practice of price walking that is of most concern, where customers are acquired at a low price and that price increases over time as the customer stays with the insurer. We all know this is an issue, and it's the way that the industry has evolved and pricing within the industry. And we've all heard the stories about usually elderly customers who have been with the home insurance provider for several years, and their premiums are £1,000, and they can get a new business quotation for around £200. And this is what the FCA are hoping to remedy with this approach. So they have identified a large number of policyholders who are paying higher than they should at renewal, and usually driven by tenure. Actually, as a proportion of total policyholders for motor and home insurance, it's a relatively low percentage. And the FCA has acknowledged that there is a figure of around £2.3 billion that is invested by insurers into acquiring new business, and that this cost will have to be borne by all customers if the changes were to take place. So the idea behind it is to make the markets work better for consumers. But as I say, it creates something of a dilemma for the FCA in terms of there are a small proportion, which is a large number of consumers, who are being priced unfairly, but any changes are going to impact the whole market. So it was a bit of a dilemma, but they're on the side of making the changes, and that's what's currently in consultation at the moment. So the main pricing remedy that we're looking at is a ban on dual pricing. So when a firm offers a home or motor insurance renewal price, that price must be no higher than the equivalent new business price that the firm offers through the same channel. There are also additional measures that have been put in place. There's an anti-avoidance provision to stop insurers trying to get around the spirit of this. And there is a attestation provision as well, which means that a senior manager must be responsible and take accountability for ensuring that pricing is compliant with the change. The FCA admits it has not taken the strategic actions of insurers into account fully, and that the proposed remedy would eliminate the cross-subsidy and may lead to higher pricing for regular switchers. This group does represent the majority of motor insurers and quite a large proportion of home insurance customers as well. So there is likely to be a bit of an impact there. I think the effect is really dependent on how it impacts new business competition, which the FCA has stated that it expects to remain fierce and driven by more product differences in terms of quality and service to make those decisions by the customers. However, it's going to be quite a behavioural change in a market which is largely commoditized and very much price driven. We're looking at kind of loss ratio improvements in 2020, which actually are predicted to deteriorate very quickly as we move into 2021, and downward prices have been observed throughout the year since February, really, and the market is due for an upward movement regardless of any change to regulation. So that's the current position that we find ourselves in. It's not an easy one, and it's difficult to say what's going to happen to the market or specific insurers within it as a result of it. At this stage, I'd just like to run a quick poll, and I'd ask, to what extent do you think the FCA changes will be positive for the insurance industry? So that should be appearing now. So if you'd like to log your answers there, we'll have a look and see what that looks like. So I'll give it a couple of moments. Okay, let's end it there. Okay, so we're seeing 72% of respondents are saying that the changes are going to be somewhat positive or very positive, so 12% in the very positive camp, and we've got 18% saying it's going to be somewhat negative. So I think the vast majority of us believe this is going to be something which is going to be a positive for the industry, and we will see how that might impact as we go forward. Okay, so looking at what are the potential strategies that insurers may take to address the changes that are being proposed. So we're looking at cashing in. So there may be prices dropping initially as insurers and brokers try to drive more business ahead of any increase in acquisition rates. So the regulations address the difference between new business and renewal pricing rather than any year-on-year price change, as there are expected to be quite a bit of variations in year-on-year changes when the changes are implemented. Then it may be an idea to do so. And we have seen continued price reductions in the market over the past couple of months, and that's going to be driven by kind of various aspects, but the FCA announcement is obviously going to be something that people are thinking about at the moment. Individual pricing, so using data enrichment to be much more targeted in pricing, so taking less of a modeled approach and more of an individual customer approach may enable you to be more targeted about acquiring the best business that's more likely to stay with you. We may see more propositions in the market, more economy propositions, which will allow insurers to maintain top positions while still charging the same price at new business and renewal for their existing customers. So there may be alternatives on offer if the customers are looking for a cheaper price in terms of what that product is. However, we must remember to stay within the kind of product governance frameworks when developing any new propositions to make sure that they remain suitable for customers and are kind of meeting customer needs. There's likely to be an increase in model sophistication, particularly in risk modeling, as this becomes a more important aspect of predicting customer value. So we may see investments being made in that in terms of people and systems. There may be some arguments to legitimize price increases at renewal. So there may be pricing factors that are available at renewal, which are unavailable at new business, which will kind of enable prices to be priced differently. Again, these are things that would have to be discussed during the consultation period with the FCA to get a view on whether these types of movements would still be in line with the spirit of the changes. And in terms of rate offsetting, there's going to be a rebalancing between renewal and new business pricing. I think this is clear, but the extent of that rebalancing may be different. So some customer groups may receive greater reductions than others. Some of those may be offset by increases to other customer groups. So these are just a few potential approaches that insurers may take. And I think there are obviously quite a lot of options available. And we'll have to see how those play out as time goes by. Okay. Sorry, I meant to say at the beginning, we will be having a Q&A session at the end, but please feel free to raise any questions that you have in the chat as I go through. So we'll kind of review those from the chat at the end, and I'll be able to answer some of those, hopefully. Okay, so in terms of preparation, what is it that you can do now to start to prepare for the upcoming changes? So there are a few different areas that we can look at in terms of the process of preparation, and I'd like to go through each one of those individually now and look at what can be done. So the first thing that insurers and brokers need to be doing right now is gaining a better understanding of the current situation. So the LTV calculation, lifetime value, is a good place to start. So how reliant on out-year price increases is your current LTV? And when do you expect to achieve profitability by particular customer segments? Tenure is another area to look at. So what does the impact of tenure look like in terms of income and retention for your business? How much are prices actually increasing based on tenure currently? And are there already caps in place? Or is your optimization has been allowed to price based on elasticity and value in an unconstrained way? What are the typical variances between new business and renewal prices by segment? And how does that look in terms of your own mix of business? So is your typical profile more or less likely to shop around? How does your average premium look? Is it a high average premium, a low average premium? And what does the age mix of customers look like? You then look at the dynamics between the back book and front book. So what proportion of business currently is acquisition? What proportion is renewal? And how does this look by tenure? So what does that mix look like? And then there's the optimization approach. So how does that currently work? Are there additional rules in place that might be impacted by the proposed remedy? Do acquisition prices based on quote behavior or certain timings? And if so, can these be equivalent to the renewal price? So I think there are some practices currently in place at acquisition that may not be in place at renewal, and we need to look at addressing whether some of these practices are in line with the proposed remedies. So a thorough analysis of the current state should help identify how much of a challenge or an opportunity the proposed changes are likely to be. Once you've got a view of the current state, it then puts you in a good position to start doing some scenario modeling. So a kind of very easy thing to do and a quick way, and it's probably useful to take a look at, is a standalone reduction of renewal prices. So if you were to bring your renewal pricing down to match your acquisition pricing, what's that likely to do? And remember, there are certain implications to consider in terms of retention is likely to be different from what you've previously seen. And there may be differences in conversion as well if it's communicated well. So if customers are kind of converting with an understanding of upcoming prices not increasing or not being different from upcoming acquisition prices, then that might change. And there's likely to be a change in shopping behavior as well. So I think what we've got here is something which will require quite a bit of assumption. So assumptions will have to replace predictive modeling in terms of looking at retention and conversion rates, because the market's going to change and expectations are going to differ as well. You can look at an increase in acquisition pricing. So again, the converse of what we're talking about with renewal pricing. So what happens if you were to increase and adjust acquisitions? And again, thinking about the market, everybody else is in the same position. So people will have to react and respond in their own ways. So those are other assumptions that you should make within your scenario modeling. A more realistic view is a rebalancing between renewal and acquisition pricing. So we'll see some prices coming down, some prices going up. And again, as I say, that may vary by segment. And it's really where you see the value in doing it and running some of these scenarios, taking into account how the market's moving and what you expect competitor response to be, to see, well, what is the likely impact of any of these actions. You could take a view at individual versus segmented pricing. So if you are kind of invested in data enrichment, if you're already receiving a lot of information on customers at point of quote, then this is something that you could start to use more in terms of developing individual pricing as opposed to more segmented views. And that may help you to better target some of those more valuable customers. New product development. As I mentioned, there may be opportunities to develop additional products. So the FCA is keen to see competition driven by differences in product benefits, quality and services. So this may be an opportunity to look at. So if you were going to develop some additional propositions, how might that impact on the expected impact of what we're seeing here with the changes? And then there's the market and competitor response. So you're not operating within a vacuum, and anything you do is likely to be influenced by and have an impact on your competition specifically and the market more generally. And it's really key to be able to, at this modeling stage, make some assumptions about how you think your competitors are going to move, who your specific competitors are to begin with, how they may move, and when they might move, so that you can then adapt your assumptions and to address these different changes. And it's something that's going to be going on for quite an extended period into next year. So it's really key to have a view on how the market's responding, how your competitors are going to react to this as well, and how that's going to impact you. Tools like Pearson Ham's daily price tracking for motor and home insurance are a good way to do this. And if you've downloaded the information, you'll be able to take a bit of a look at that and how that might be able to support. Once you've got a view on your current state and have modeled a number of scenarios to look at the potential impact of the change, you should then be able to get into a position where you can come to an agreement with senior management on the appropriate approach to take. So this is a fundamental change to the way that general insurance is priced and the business model within the UK. So you will have to address your overall business goals as part of this, and it may mean a kind of complete reassessment. Organizational strategy will have to be reviewed as well, and the pricing strategy that's being proposed aligned with that of the overall business. And it is essential that senior management understand and support the proposed changes that you're making. You should then come up with a clear articulated set of pricing principles to provide the framework for subsequent development. And things will have to change, and the team structure may be part of that. So is the current structure appropriate for the changes that you want to make? And if not, what needs to change in that regard? It's then going to be crucial to establish appropriate levels of governance for this. So who should the senior manager be, taking accountability for compliance with these changes? And what does the effective product governance framework look like? What should be included in that, and how should your products be assessed? Once the approach is agreed, it then comes down to careful planning and the need to deploy effectively. So again, this is not a short-term fix, and the deployment is going to be crucial to success. Lifetime value, as I've mentioned, is an area which has been growing in sophistication and accuracy over recent years and has resulted in a lot of the investment that we've seen into acquiring new customers. So that £2.3 billion that insurers are investing is driven by enhanced sophistication in prediction of lifetime value. Again, this is something that's going to have to be completely reassessed because the expectations will no longer be the same. So I think we can start with a review of factors that are being used to predict lifetime value. Are they relevant? Are they compliant? And should anything else be included that currently isn't there? We then need to look at a re-estimation of outer years. For the back book in particular, recently acquired business, there will have to be a re-estimation of what that outer year's income looks like. So customers that you acquired last year and you expected to make a certain amount over a period of 5 years are going to look very different than they did previously. Retention assumptions will have to be reassessed. So renewal behavior is likely to change, both due to the regulatory impact and the effect that has on year-on-year price changes that customers are seeing. So we know that a variance from the previous year's price tends to have a detrimental effect on retention rates, whether that's an upward or a downward movement. It seems to trigger shopping around activity. And then conversion assumptions. So as customers become more confident in the prices that they're seeing, and if the awareness of the regulatory change is kind of visible, then there may be more kind of conversion impacts as well. And behavioral change. So other behaviors might change over time as the dynamics between new business and renewal evolve. And this should be considered in the LTV calculation as well. I think it's likely to take quite a long period of time for customer behavior to change, which we'll come back to slightly later on. And there may be other processes that can change or should change or will change, and these may affect things like conversion and retention. So the communications that you have in place, the renewal invites that are being sent out, the wording, the kind of communication and education of customers around the regulatory change as well. Once this has been established, you've got a new view on LTV, you've come up with a pricing approach that's been agreed with senior management. We now get into looking at the price calculation and changing how that's done. So there's a re-optimization. So this will have to be implemented based on the agreed strategy and the new objectives. So looking at how the objectives may change based on the proposals that you've agreed and the new competitive landscape. What constraints should you have in place? So based on the regulatory change, should your constraints be amended? And what should you be looking at in terms of both renewal and new business pricing? Elasticity assumptions will have to be reassessed. As price changes are mirrored across renewals and new business, then a more blended approach would be appropriate. So some of your potential customers are new, some of your potential customers are renewing, and you have to kind of assess the differences in elasticity between those two if price changes are going to be mirrored across both transactions. The more personal information you have on individuals as well will be helpful. So data enrichment could play more of a part in terms of being able to identify the most attractive customers and pricing effectively. There are then the art of optimization rules. So some of those rules that we see more likely at acquisition around quote behavior and timings and day of week pricing that we've observed. So those types of things we may need to reassess in terms of how equivalent to the renewal price can you be where changes are being made based on things that are happening which would not necessarily happen for a customer at renewal. So once you've kind of worked out what you want to do, you've kind of made those changes within your optimization, you've looked at the modeling that you've got in place, you've renewed your LTV assumptions, then comes the challenge of implementation. So when it comes to deployment, you should start thinking about what the potential system challenges you may have. So how easy is it to actually align your new business and renewal pricing using the current systems? And what differences do you have in place in terms of kind of the number of days to inception or capping and collaring at renewal? And how are those things currently being implemented? You may need to think about technical development. So in terms of IT lead times, if you want to get some of these changes in before the new rules are live, then it's probably wise to start thinking about that now. And following initial deployment of changes, you need to be closely monitoring what's going on, not only of how your own price changes are performing, about how your competitors are moving and how those may be impacting you. And I think it's really important to have some iteration options. So this isn't just you're going to come up with an approach and deploy it. You need to be responsive and reactive to what's going on in the market and have a number of scenarios which support your pricing strategy and to be able to change and to deploy those when needed. Communications are going to be key, and this is internal communication. So the senior management needs to be updated on a regular basis as to what's happening in the market, what's happening with the pricing approach, what changes are being proposed, and to ensure that the appropriate levels of governance are in place for that. And as I say, this isn't a short change. This is something which is going to be impacting for a long time and requires ongoing assessment. So there will continue to be changes happening within the market, and it's key to be able to track those and to make sure that you're maintaining an up-to-date view on what's happening, how that's impacting your own pricing approach, and any changes that you should take in response to that. Okay, so that's a brief summary of what can be done to prepare for the upcoming changes. And I'd like to take another poll right now, looking at the how well prepared you are. So that's what to do to prepare. So in terms of where you are currently, how well prepared do you feel you are for the proposed changes? So that poll is going live now. Okay, so I think I'll end that poll there. So we're seeing 58% are somewhat prepared. We've got a 5% are well prepared, but we're still seeing sort of somewhat unprepared or unprepared. And there is somebody there who's not yet thought about it. So hopefully this will help with some of that thinking. But good to see that. And I think this is probably in line with expectations, given the conversations that we're having within the industry. People are kind of starting to prepare for it. Projects are in place, and kind of the kind of initial planning, the initial view on how does it impact currently is underway, and it really is kind of now thinking about the scenario modeling and what the approaches should be. Okay, so in terms of customer response, how do we think customers are likely to respond in kind of reaction to the changes that are coming up? So shopping around. So as I mentioned earlier, year-on-year price change is one of the key drivers of shopping around activity. Whether that's an upward or a downward movement, it does tend to trigger that behavior. And as prices start to rebalance, the renewal price may be considerably or slightly lower than the previous year's price, if that's the way the alignment is happening and the rebalancing is done in that way, which again could trigger some of that shopping around behavior. So I would expect to see an increase in shopping around. For customers who are very latent, it's probably just a good deal, and they're quite happy to stay with their provider. They're getting a better price. But for those who are more likely to shop or on the cusp, then I think it's likely to increase that that shopping around activity. In terms of switching, so shopping around activity may increase following the implementation of any rebalancing, but will we see a similar increase in switching behavior? I think it's likely that switching will increase initially because different insurers and brokers will be responding and rebalancing prices at different times. So there are still likely to be good deals available initially as customers start to shop around. As the competitive landscape shifts a little, then we may see kind of dropping off of that. So a clear understanding of who's doing what in the market and when is going to be crucial to an effective strategy to deal with this. As things settle down, as I say, it's likely that the previous deals that customers were able to find through shopping around are kind of not there as much as they would have been previously, and it's likely that the switching may decline over time. So there's likely to be an increase in shopping around activity that might increase switching behavior initially. Over time, as prices rebalance and the deals that were previously available are no longer there, then we may see a reduction in that behavior. So this is thinking about the behavioral change. Over the past 10 years, certainly, customers have learned to shop around, look for better deals at renewal and or negotiate with their existing provider. And it's going to take quite a period of time for this behavior to change. This is now the norm on motor insurance. 70% of customers are doing this when it comes to renewal, that they are shopping around. Customer segments with a greater propensity to shop around are likely to continue to do so. A lot of this is driven by premium. So if you've got a higher premium, you've got more to gain through investing your time in trying to find a better price. I think that's going to continue. Others may become less likely to do it over time. So if the reward isn't as great, your premium's relatively low, then it may be just as easy to stay with your existing provider. You'll feel more confident that you're not being ripped off, and that the prices that are being offered for renewal are competitive for you. However, as I say, I think this shift in behavior is going to take several years to mature, and price comparison sites aren't going away. So they're going to do whatever they can to ensure that customers continue to shop around and continue to switch to alternative providers, because that's obviously how their business model is working. Okay, so to conclude, the proposed changes will mean a massive shift in the way general insurance pricing works. This is likely to result in higher overall prices for most customers, given the proportions of customers currently identified by the FCA as paying too much. The converse of that is there are quite a large proportion of customers who are not paying enough, and I think overall prices for the majority will have to increase to account for this. So I think we'll end up in a position where overall prices are slightly higher, but there will be a greater degree of fairness, and the proportion of customers who are currently overpaying will now be more confident and being treated in a fairer way in terms of prices that are being offered to them. So as I say, I think the change represents opportunities as well as challenges. There are several strategies that insurers and brokers can adopt, and different timings for implementation of these, and a good understanding of how the changes are likely to impact your business, and a clear planning of approach will be crucial to success. So really nailing down what needs to be done, what's currently happening, and agreeing the processes internally, and ensuring there's a very kind of clear and detailed plan for implementation and deployment, review and monitoring, and change as we move forward. You also need to keep a close view on what's happening within the market. So in home insurance and in motor insurance, we've already seen a great deal of fluctuation this year following the COVID outbreak, and we've seen prices reducing throughout the year, driven by that and some other factors. But it's going to be more important than ever to be able to check as we move into next year what's happening in the market and what your competitors are doing and when. We're likely to see more shopping around behavior. I would expect the volumes of shopping around customers to increase, and switching also to increase initially, but again, that may reduce over time as the deals that were previously available are no longer there to be found. And as I say, I think it's going to take a long time for customer behavior to change. They've been trained to behave in a certain way over a long period of time. So over the past 10 years, shopping around, negotiating with your provider. So again, this behavior won't go away quickly, and it's something that you need to think about when you are considering a new LTV calculation and a new lifetime prediction as to what does that consumer behavior look like over time, and how does it evolve. Okay, so I shall take some of the questions that have been logged in the chat now. So how do you interpret the term equivalent new business price? So I think there is a bit of interpretation possible with some of the wording of the FCA. So they've used the term equivalent new business price. They've also used a term through the same channel. And there was a webinar that the FCA did a couple of weeks ago where somebody raised that point and said if it was a different brand, would that be considered a different channel? And the response was yes, that actually would. So I think that gives the opportunity for kind of new product development for those kind of economy propositions that may be able to achieve kind of higher positions. So yeah, I think it's fairly open to interpretation, but I think it's one of those things which it would be very helpful to be able to clarify that directly with the FCA, because if you get it wrong, then there are implications of non-compliance. So I think it's one of those which is a bit open. Surely this will not impact smaller markets such as pet until much further down the line, 2022. Potentially, yeah. I mean, the pricing remedy has been proposed for motor and home only at the moment. Some of the other measures have been kind of proposed across other general insurance markets, And I think it's a case of kind of wait and see what happens. I think this is a bit of a test case for the FCA in terms of applying this to motor and home. They're hoping that overall prices will be lower. In the kind of the report that they produced in September, that was something that they stated that they expected to happen. So I think it's really a case of kind of implementing this, monitoring things, coming back to it in a year's time to say, well, has it had the impact that they expected it to? And only after that would I see any kind of pricing remedies being rolled out to other markets. Which skill sets do you think will be most in demand as a result of these changes in the short, medium and long term? I think there are kind of a couple of different areas where skill sets and people with certain skills will come in useful. I think one of them is in terms of modeling. So the greater sophistication and accuracy in modeling could help in terms of being able to target the most attractive customers. I think we're also looking at, in terms of data enrichment, being able to include other external data sources or make use of internal data sources to enhance that. And I think there's something around commerciality. So on the kind of the non-statistical side of things, being able to assess the market in terms of kind of a set of assumptions around how do you expect, based on feeling, the market and behaviors to change, and how should that impact your LTV. So somebody's who probably less actuarial and less statistical to support any advancements in modeling. With renewal prices expected to fall, why do you believe that shopping around will increase? It's a good question, and it's something that we've seen consistently across a number of different books, where prices change year on year, whether that's an upward movement or a downward movement. In motor and home insurance, we tend to see shopping around activity increase. So the kind of the best retention rates we see are where prices are the same as last year, and where prices vary from that, even if they are lower, we see increases in shopping around. And if you look at some of the segments, you might think, well, actually, it's because they were expecting a bigger reduction than they actually got. They may have gone from a different step in the kind of the NCD years. But if you strip out that and account for it, there still is an element which is unexplained, and it does seem to be a trigger for that. Do you have a view on fairness when it comes to the ancillaries and credit charges? Do you expect change? I don't expect too much change, because those things are included in the FCA report. So they've certainly been fairly comprehensive in the approach in terms of pricing, to say that they will consider these other revenue streams as part of it. So if kind of there are expectations where we will be able to make that margin back through increasing our kind of interest rates or repricing of ancillaries, well, actually that's something that they are looking at. So I think I would be a bit careful about taking that approach. And I mean, if there are justifiable reasons for doing it, if you can enhance your product suite, if you can bring in things which meet customer needs, which are kind of fully compatible with the product governance frameworks, that are kind of they're doing something that they provide value, and the kind of the pricing justifies that, then I think there are opportunities to do that. I think rather than just looking at repricing things overall. Okay, I think that's all we have time for. So yes, thanks for joining today. And I just say, if you wanted to talk through any of the issues that we've discussed today, or if you could use some support in thinking through your approach to this, then please feel free to contact me. My email address is on there, stephenkennedy@pearsonham.com. Or if you'd like some more information about our market price monitoring services. So as I say, we have daily market price tracking for a car and for home in place. which will allow you to keep a view on what's happening in the market, what your competitors are doing, and when they're doing it. So thanks very much for joining me, and best of luck in your actions to address this. Have a great Christmas and New Year.